Well, as you've heard, it was an action-packed ride today, the sort of ride that leaves you throwing up on the grass afterwards. The All Ordinaries fell 5% at one stage and then bounced back, apparently on suggestions that the Federal Reserve is warming up the printing presses again. The Aussie dollar also bounced off its lows at the same time, and that low was below parity for the first time since February, although unlike shares, the dollar is still below where it was yesterday. In general, the share market and the dollar have been like synchronised divers this month because both come under the heading of R for risk in the Global Investment Fund filing cabinet. As you can see, the share market got back what was lost this morning, but it's a steep climb to get back what was lost this month. That's in Ben Bernanke's hands. Horrendous falls in Europe and America overnight, as you've heard, and the biggest drop among all global markets was Russia, an R for risk market if ever there was one. By the time those markets closed, the rumours about money printing hadn't started up. And the US bond yield has finally gone up, having dropped like a stone after it was downgraded from AAA to AA plus by Standard & Poor's on Saturday. Yields are supposed to go up when that happens. Markets in Asia were clawing back early losses a short time ago, with the China market trading roughly steady on the day. And on commodity markets, gold kept going up, but other commodities, including oil, were dumped in the scramble to unload risk. Here's a comparison of the 2008 and 2011 crashes by the Dow Jones average. Now, the one 3 years ago, 2 weeks after Lehman Brothers collapsed, was much worse than this one, so far. And finally, a bit of economic news. Business confidence actually went up in July, although the share market will have fixed that in August. And new home loans fell in June, explaining why the banks are now cutting rates. And that's finance.